This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here again at AusBiz. Let's get across the moves overnight. Equity markets little changed as investors paused to consider the impact of President Trump's new tariff regime as he slapped a 50% tariff on imported copper. It was a volatile session on Wall Street as investors waited for clarity on US trade policy, the S&P and Nasdaq oscillating between gains and losses. And while investors were wary of making big moves in larger stocks, the Russell 2000 small cap outperformed. Among the mega caps, Tesla gained after its stock recorded its steepest single-day fall in roughly a month the previous session. US copper miner Freeport benefited from the prospect of steep import tariffs on the metal, while US-listed shares of BHP and Rio finished in mixed territory. Moderna was the biggest percentage gainer after leading medical organisations filed a lawsuit against US Health Secretary Robert Kennedy Jr. and Department of Health and Human Services, arguing the current COVID vaccine policies pose a threat to public health. However, US pharmaceutical stocks also slid following Trump's threat of a 200% tariff on drug imports, which he said could be delayed by about a year. Shares of solar stocks slumped after the Trump administration directed federal agencies to strengthen provisions that repeal or modify tax credits for solar and wind energy projects. Well, US President Donald Trump has promised to impose a 50% tariff on imported copper, followed by levies on semiconductors and pharmaceuticals. A day after he threatened 14 trading partners, including major exporters Japan and South Korea, with sharply higher tariffs, he reiterated his threat of 10% tariffs on products from Brazil, India and other BRICS nations. He also said trade talks have been going well with the EU and China, but says he's still ready to slap heftier tariffs on EU exports. And locally, after the Reserve Bank surprised markets by leaving interest rates on hold, Australian three-year government bond yields rose to 3.48%, the 10-year up to 4.36. Markets now pricing in a 90% chance the RBA will cut the cash rate by 25 basis points at the next meeting on the 12th of August. US two-year Treasury yields, they're little changed at 3.9%, the 10-year at 4.41%. And the US dollar index up slightly, while the yen remains under pressure after President Trump reiterated his plan to impose 25% tariffs on goods from Japan. The Aussie dollar jumping higher after the RBA interest rate decision, currently at 65.3 US cents, and Bitcoin is trading just below 109,000 US dollars. Oil prices have edged higher on forecasts for less US oil production, along with renewed Houthi attacks on shipping in the Red Sea. Brent crude futures up at $70 a barrel. Copper prices have surged around 10% in response to President Trump's 50% tariff on copper exports to the US. Iron ore around $95 a tonne, and gold slipped more than 1% on a firmer US dollar and rising Treasury yields. Spot gold at around $3,300 an ounce. Well, to get across what we're seeing in the US and more globally, with a focus on equities and what is ahead, Mike Dickson is the head of research at Horizon. I caught up with him a little earlier.
Come up against these deadlines now and again, kind of push them out a little bit. Look, the reality is the market's become quite desensitized to all of this back and forth. And, like here in the US, of course, we just came off actually the quickest recovery in the history of the S&P 500 for any pullback more than 15%. It took just 54 trading days for, this recent tariff drawdown to be completely erased and reversed. And now we have a deadline that's kind of come and gone. We have a new deadline. I think the markets overall are pricing out, certainly pricing out a lot of the risk associated with a worst case scenario, and have really become desensitized to all this back and forth. And look, I think that's going to present some opportunities because we are going to get a lot of headlines, likely get some tactical type of pullbacks in response to this. And quite frankly, I think all of those are going to be buying opportunities, as I think the market and myself are certainly convinced that ultimately this is a negotiating tactic, and I don't think that the worst case scenario is really on the table.
Yet, Mike, do those risks remain? Certainly, given markets, equity markets at or near record highs at the moment. So, do you see them perhaps as being overvalued? And this, of course, as we head into earnings season.
Well, look, I mean, one of the best ways to judge just kind of like what type of risk the market's pricing in is going to be looking at valuations. And believe it or not, where we sit today from a valuation perspective here in the US is at a slightly higher place that we sat to start the year. And look at what's happened this year, right? So, look, I do think it's going to be tough for valuations alone to continue to expand and take the market higher, especially since, here in the US as well, we don't have any more expectation for rate cuts as we sit here today that we did to enter the year. So a lot of that valuation, kind of expansion that we've seen isn't driven from that aspect. That means we've got to look at the hard data. We've got to see earnings estimates actually get revised higher in a meaningful way in order for the market to kind of really break out from the highs here that we've recently recovered from. And, we get the first look at that, really starting next week. And, there's still uncertainties around tariffs. So much in focus this time around, just like last earnings season, is really going to be on that guidance and what companies expect with, again, still a lot of these uncertainties out there and a little bit less focus on kind of what has happened in the rear view. And I think that's what markets are going to be most focused on as we really get into the crux of earnings season, over the next 3 weeks.
So, Mike, you say no prospect there of stimulus from monetary policy, certainly in the short to medium term. What, though, of Donald Trump's tax bill? How are companies likely to react to that, given obviously those tax cuts and how that may influence their capex?
Quite a bit of incentives in the tax bill, as you mentioned, around capex. Certainly, some of the tax incentives related to being able to expense some of the items used for more capital intensive industries are going to have a pretty big impact. I think when you look across the types of stocks that's going to impact the most, you're going to see capital intensive type industries and exposures on the infrastructure side of things benefiting a lot from that. I think you're also going to see small and mid cap companies that don't have the behemoth of balance sheets and cash on hand are going to benefit quite a bit from that. And tactically, I think that also makes for an interesting opportunity as you kind of move down the cap spectrum and not just talk about the big tech behemoths. I think those capex incentives and other tax incentives to promote investment is going to have a real big impact on some of those smaller cap companies that have been constrained by the kind of higher for longer narrative that we've had with interest rates, and that could be a pretty solid relief valve that we will hopefully see and hear folks talk about through earnings season over the next couple months, and would really be an excellent way to inflect those earnings upgrades higher for those smaller mid cap segments, because believe it or not, the large cap market's up quite strongly here year to date, but the smaller cap market's still in the red. Presents I think a pretty good medium term catalyst for looking at that trade more in a larger allocation as we head into this hard data season ahead.
So you point out that Mag7 block trade no longer really appropriate, is saying it's broadening out. Diversification is the key here.
I do believe so. I mean, the Mag7 is no longer a block trade, right? So it's not just buy them blindly and you're going to go up in value. This year, you've already seen a substantial divergence. We have several of those big Mag7 names that are significantly in the red. You have several that are well up over 20% year to date. So you're seeing bifurcation amongst the Mag7. Really, those companies that are able, I think, to capitalize on the AI theme and do it in a very responsible, profitable way. But then outside of the Mag7, I mean, there's a couple areas I think that are very interesting. International markets, primarily being one of them. It's been a while since international markets have really been able to take the baton away from the U.S. This year has been one of those years thus far. I think A couple of contributors to that are the kind of weaker dollar that we've seen as we're getting, a little bit of policy divergence here in the U.S. compared to the rest of the world. But then also from a diversification standpoint, international markets are not nearly as heavily concentrated in, the top end of the market in the technology sector. And so you do get quite a different, sector composition with just more diversification naturally built in, given how, international markets, ex the U.S. really look. And I think that is going to be a great trade for the second half of the year. And again, this is what we saw back in 2017 as well during Trump's first term, was a really strong performance from the international bloc as a whole in that first year. We're seeing much the same here. And then finally, the small mid-cap space, I think as well, here in the U.S., a great way to play that diversifying, broadening out theme that could really have, some medium, longer term catalysts as it relates to this recent bill that got passed, as well as, it's an opportunity for a catch-up trade, much like on the international side of things.
And Mike, in regards to fixed income, is the 60-40 portfolio still appropriate at this point, do you think?
I think the 40 part of the 60-40 has been challenged for quite some time. Just going back to, of course, 2022, that was completely the case with interest rates going up a significant amount and diversification completely failing. But then since then, we've still really failed to see, interest rates really break out in one direction or the other. And a lot of the times that we've seen weakness in equity markets, it's been caused by rising interest rates. So you're not really getting that diversification benefit that investors have come to know and love out of fixed income, for quite some time. And then, on top of that, here in the U.S., you can get the same yields for a shorter term, basically T-bill, 3-month duration Treasury bill compared to the longer term 10-year yields and beyond. So you're not really rewarded for going out of the duration curve when within the Treasury market. And so I think you really got to think, what else am I going to do with that 40%? And there are quite a number of options available to do so. Defensive equity strategies are one way. Not all equities are created equal. They're not all the same risk. So substituting some bond exposure for more defensive oriented, high quality, defensive takes on the equity market is one way. And derivative strategies that have become quite popular to wrap inside of ETFs can be also a great way to reduce that equity exposure, still give you that 60-40 feel, but don't have nearly that interest rate risk that you would get out of a traditional Treasury or otherwise medium duration bond. So I think those are a few options that have really become something investors should take a serious look at, especially given the state of the fixed income market. And I think that's going to be here to stay for a little while.
That is Mike Dickson, Head of Research at Horizon. Let's refocus then locally as we're just about to get going on the market here. SPI futures indicating a modestly lower opening, down some 7 points. Stay with us. We'll get right across that in just a minute.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.